If you've been watching the oil ticker lately, you know things are, well, a bit wild out there. Welcome to this explainer. Right now, as of August 5th, 2026, we are dead center in the middle of a massive geopolitical tug-of-war. And today, we're going to break down exactly what is happening behind the numbers. Let's just dive right into the data because it is staggering. We've seen a massive 10% price plunge over just the last 2 sessions alone. That actually pulled Brent Crude all the way down to $79.14 a barrel, with WTI hovering near $75.06. We're talking a third straight day of steep losses, and it's a dramatic shift that we really need to look at closer. To understand why prices are tumbling so fast, we'll map out this exact tug-of-war. Diplomatic optimism pulling prices down versus physical reality pushing them right back up. We'll quickly run through the oil market today, the hopes for the Strait, OPEC's latest moves, the reality on the ground, and then we'll wrap up with the long-term forecast.
All right, Section 1, the oil market today. Let's look at the most immediate spark driving today's market drop.
To really get this, you have to understand the stakes. The Strait of Hormuz controls roughly 20% of the entire globe's oil and liquefied natural gas supply. That is a massive chunk of global energy. Its recent closure has literally been the central factor keeping oil prices so elevated for months. So when you introduce even a sliver of hope about reopening it, it sends absolute shockwaves through the market, instantly easing supply anxiety and pulling prices down. Which brings us to Section 2, Hope in the Strait. This is the downward pull in our tug-of-war, currently being brokered by Qatar, Pakistan, and Oman. Now, what's fascinating here is the sheer contradiction between the two sides. Look at the U.S. perspective. Treasury Secretary Scott Bessent is suggesting a deal is just days away. President Trump is aggressively pushing a 2-phase approach, Phase 1 to reopen the Strait, and Phase 2 to deal with Iran's nuclear program. And U.S. Secretary of State Marco Rubio is out there noting that actual progress has been made. But then, on the flip side, Iran outright denies that direct talks are even happening, claiming they are only talking to Oman about managing the Strait. So the reality? Talks are definitely happening through middlemen, but both sides are intensely guarding their public leverage. Despite those conflicting public narratives, there's actually an interim proposal drafted by Qatar, and it maps out a very precise 3-step choreography for reopening the waterway. Step 1, inbound shipping routes through Iranian-controlled waters. Step 2, outbound traffic takes Omani-controlled lanes. And finally, Step 3, Iran insists on testing the route with its own vessels first before any commercial international traffic is allowed back in. Sounds like a plan, right? Well, progress is currently hitting a brick wall over 3 massive sticking points. First up, who ultimately controls the Strait going forward? Second, who actually blinks first to make the first concession? Does the U.S. ease up, or does Iran halt its actions? And third, the really contentious one, transit fees. Iran wants to charge fees on vessels passing through, and President Trump has absolutely firmly rejected that idea. Moving on to Section 3, OPEC opens the taps. Adding to that diplomatic optimism, we have a major production decision acting as another downward force on prices. On August 2nd, 7 key OPEC Plus nations, we're talking heavy hitters like Saudi Arabia, Russia, and Iraq, held a virtual meeting. They basically agreed to start unwinding their 2023 voluntary cuts by increasing production by 188,000 barrels per day starting this September. The stated goal here is to just give member nations a chance to compensate for past overproduction. But, and this is a massive caveat, higher production quotas do not automatically mean more oil actually reaches the global market. Think about it. With the Strait of Hormuz severely disrupted and Ukrainian drone attacks effectively hitting Russian energy infrastructure, all those newly authorized quotas might just be physically trapped. Pumping the oil is one thing. Getting it safely to the global market is entirely another ballgame. And that leads us perfectly into Section 4, the reality on the ground. Because while diplomacy is pulling prices down, physical reality is aggressively pushing them upward. Data from Goldman Sachs reveals a truly alarming physical squeeze right now. Gulf oil exports have just plummeted, falling from 80% of pre-war levels back in early July to just 36% today based on a 7-day moving average. That is a devastating loss of flow, and it's forcing major producers like Saudi Arabia to completely reroute via Egypt's Sumed pipeline just to get their product out to buyers. And the danger out there is very present. While the diplomats talk, global visible inventories are shrinking fast. We're talking a drop of 6.3 million barrels per day over just 2 weeks, driven by those lower exports and stronger Asian imports. Plus, ships are literally under attack. Just today, the Houthi movement claimed an attack on a Saudi oil tanker in the Red Sea off Yanbu. That actually pushed Brent Crude briefly back over $80. Separately, a cargo vessel was struck by some unidentified projectile near the Oman coast, and tragically, a seafarer is missing. So the physical risk, it's incredibly high. And history gives us a pretty brutal reality check on all this. Remember the last US-Iran ceasefire? It collapsed in less than a month over this exact same issue with Hormuz. When the fighting resumed and spread to the Red Sea, it triggered a wild $32 price swing in Brent Crude. The market has an incredibly short fuse. Finally, let's look at Section 5, the long-term forecast. Given this intense geopolitical tug-of-war, what are the big financial institutions predicting? Generally, the experts see prices hovering in the $80 range right now. Goldman Sachs puts fair value at about $80 to $90 near term, assuming a moderate risk premium, unless we see a confirmed deal or a major escalation. Meanwhile, TD Bank is looking at the low 80s by year-end 2026 and eventually moderating down into the 70s by 2027. But listen, that TD Bank forecast heavily relies on a diplomatic resolution actually holding firm. And honestly, our margin for error to achieve that stability is shrinking rapidly. The safety nets are quite literally disappearing. The U.S. Strategic Petroleum Reserve buffer has been drawn down to roughly 310 million barrels. Now, that sounds like a big number, but it's actually its absolute lowest level since 1983. I think this quote from the TD Bank economists perfectly captures the current reality. They said markets have bought time, but not insurance. We are surviving on borrowed time, burning through exhaustible buffers like inventory drawdowns, emergency reserves, and rerouted shipping. Any renewed disruption is going to hit with an outsized impact. With the world economy held in this precarious balance between diplomatic hopes and physical constraints, I'll leave you to ponder this critical question. Markets have bought time, but what happens when time runs out? We are watching a high-stakes chess match play out in real time across the world's most vital shipping lanes. Thank you so much for joining me for this explainer. Stay curious and keep seeking to understand the systems that drive our world.